Hello everybody, here is the winner of life. Welcome to our channel. If it helps you, please follow and subscribe to our channel. Your support is greatly appreciated. When the economy is under pressure from a crisis or slowdown, the Federal Reserve tends to take targeted measures, such as interest rate cuts in a bid to stimulate economic recovery. The Fed has made 4 relief rate cuts and 5 precautionary rate cuts since 1982. Here, I would like to ask you, how will you adjust your investment strategy in the face of the upcoming interest rate cut cycle? Which assets do you think will be affected by the rate cuts? Do you want to pinpoint control? You will need to be flexible in adjusting your portfolio in light of changing economic conditions and the Fed's rate-cutting cycle. Like a seasoned pitcher, you need to be able to quickly adjust your pitching strategy based on your opponent's gestures to ensure that the ball is pitched to the most favorable location. Today's video will help you. Warren Buffett's home run. The impact of interest rate cuts on asset prices. During the 2008 financial crisis, Warren Buffett, often referred to as the stock god, supported the Federal Reserve's aggressive interest rate cuts. He believed that moderate cuts could relieve businesses and households, reduce debt pressures, and help the economy regain momentum. In this challenging environment, Buffett was akin to a seasoned baseball star facing a critical moment. He recognized that a single solid hit could change the game, and he swung for the fences, hitting a metaphorical home run to guide his team through turbulent times. As the COVID-19 pandemic emerged in 2020, Buffett again urged the Fed to lower interest rates. He viewed these cuts as essential for addressing demand contraction during economic recessions, helping families and businesses navigate tough times. However, by 2022, Buffett's stance on interest rate cuts became more cautious. He argued that while cuts could stimulate the economy, high inflation necessitated a balanced approach focused on employment and price stability. Buffett emphasized the importance of weighing the pros and cons of policy decisions to avoid creating greater economic uncertainty. He also warned investors about the risks of asset bubbles that could arise from prolonged low interest rates, which might lead to excessive optimism and reckless investment behavior. Some skeptics may dismiss policy propaganda, but Buffett's actions during critical moments illustrate the significant effects of interest rate cuts on asset prices. When the economy is in recession, aggressive cuts can bolster market confidence and enhance the appeal of riskier assets, driving stock prices upward. Yet, with inflation currently high, the question remains: how should investors adapt their strategies in this complex landscape? As we look ahead to potential rate cuts, it's crucial to consider how these decisions will shape the market. Will you adjust your investment strategy in anticipation of these changes? Which assets do you think will be most affected? Buffett's story serves as a reminder of the importance of strategic thinking and adaptability in the face of economic uncertainty. The Fed's interest rate cut policy can be broadly categorized into 2 modes: relief-type interest rate cuts and preventive-type interest rate cuts. The former is common after the economy falls into recession. The purpose is to save the economy, belongs to the passive response. The latter is when the economy shows signs of slowing down, take measures in advance, belongs to the active prevention. Some viewers may ask, how can we quantitatively determine whether the U.S. economy is in recession? There are 3 commonly used methods. NBER Recessionary Range, the National Bureau of Economic Research. NBER is the authoritative organization that defines the U.S. economic cycle and determines the recessionary range by taking into account 6 major indicators, such as real personal income after deducting transfer payments and non-farm payrolls. SOMS Rule Recession Index. Economist Claudia Sam proposed the SOMS Rule. which indicates that the economy is experiencing a recession when the Psalms rule. Recession Index, 3-month moving average of the unemployment rate, the low point of the previous year, exceeds 0.5%. 3. Customized Recession Index, considering the Fed's monetary policy objective of achieving full employment and maintaining price stability. The recession status is assessed through 4 indicators: the chained annualized rate of GDP, the manufacturing PMI, the core PCE, and the unemployment rate. Combining the above judgment methods and the trend of the federal funds rate. After 1982, the Fed launched 4 relief rate cuts and 5 precautionary rate cuts. Bailout-style rate cuts are usually larger in magnitude and longer in duration. For example, during the financial crisis of 2008, the Federal Reserve took a series of aggressive interest rate cuts in response to the sharp economic downturn. During a relief rate cut, equity assets have a higher probability of rising, and investors tend to see a rebound in the stock market. U.S. bond yields go down, the probability of the U.S. dollar weakening, and gold's gains during relief-style rate cuts are higher on average. This is because, with the economy in recession, rate cuts can boost market confidence and increase the attractiveness of risky assets, while also driving bond yields down. Precautionary rate cuts, on the other hand, are relatively cautious, with smaller rate cuts and shorter durations. The Fed makes rate cuts in such cases with the aim of avoiding the economy falling into recession. The probability of equity assets rising during a precautionary rate cut is also higher, but lower than a relief cut. Short-term yields on U.S. bonds move down. The dollar moves in a mixed fashion and may rise or fall, while gold rises at a lower average than bailout-type rate cuts. This is because, with the economy slowing, but not in recession, the stimulative effect of a rate cut would be relatively limited, and market concerns about the economic outlook remain. Equity assets have a higher win rate during relief-style rate cuts, implying a high probability of rising during the cut. Based on historical data, many investors have been able to earn handsome returns during this period. With U.S. bond yields falling and the probability of a weaker U.S. dollar, gold's gains during relief-style rate cuts are higher on average. This is because the increased liquidity associated with rate cuts tends to drive investors towards risky assets, further boosting stock market performance. Equity assets also had a higher win rate during precautionary rate cuts, but lower than relief rate cuts. Short-term yields on U.S. bonds move down. The U.S. dollar moves in a mixed fashion and may rise or fall, while gold rises at a lower average than bailout-type rate cuts. Investors need to be more cautious at this stage and monitor market dynamics in order to adjust their investment strategies in a timely manner. According to FedWatch data, as of August 24th, the market expects the Fed to cut interest rates by 25 basis points in September and 3 times throughout the year. From historical experience, the Fed's rate cuts can often drive long-term funds back into the stock market, boosting market sentiment. However, we should also be vigilant about the risk of asset bubbles and avoid over-reliance on accommodative policies. Investors should remain rational, pay attention to fundamentals, and allocate assets based on their own risk appetite. The economy is like a marathon. Short-term fluctuations are inevitable, but the long-term goal is the real wealth we seek. Let's look forward to the Fed's next move and how it will affect the direction of the global economy. Thank you for watching. If this video is helpful, please like and follow our channel. Your support will be a great motivation for us to work hard.